Hello, and welcome to the second quarter edition of the Megabuyte CEO Barometer podcast. I'm Ian Spence, the founder of Megabuyte. As usual, I'm joined by my co-host, Neil Arampata, Megabuyte's head of research and consulting. Welcome, Neil.
Hello.
Thanks a lot for tuning in. As usual, our lens is firmly on the UK software and ICT services sector. We'll cover all of the key macro and tech trends and what these mean for the growth outlook, as well as our usual review of the corporate activity and valuations. For each of these areas, we'll bring out key data points and news items, discuss the underlying trends, and aim to help listeners understand what this means for their business. Well, Neil, what a difference 3 months makes. We sat here in early January, the budget was out, and we were thinking quite positive thoughts, and we were feeling there were some green shoots around in the tech sector after a couple of very challenging years. Today, however, we have war in the Middle East, we have a SaaS apocalypse upon us, and there's a growing nervousness about the $2.5 trillion private capital market. So plenty to talk about. Let's dive in.
Mm-hmm.
So we're going to start with what we were just a minute ago describing as various Greek mythology. The three-headed dragon, 4 horsemen of the apocalypse, but actually 3 horsemen of the apocalypse. But 3 key things that have happened since we last spoke to everybody or are happening. One is obviously the war in Iran. The second is the SaaS apocalypse, which we'll get into. And the third, which was sort of around when we were last here, but actually has got a lot more significant, is this idea of the private debt markets. So we're going to go through those, talk about what those might mean for the outlook for the UK tech sector. So let's start off with the Iran war. I think obviously that one always has to mention that it's a war, and so the most significant impact is on the people that are involved with it. So we have to mention that and be mindful of that. But from a UK tech sector perspective, it feels like who knows what's going to happen with the war itself? But it feels like we're stuck with $100 oil for the foreseeable, really. Certainly for the next few weeks or months, depends where we go with that. So it's worth just us spending a little time talking about what that might mean for the tech sector. I mean, I sense, we're already seeing lower economic growth. We've already seen downgrades from the IMF or one of the big bodies downgrading UK growth expectations. We're expecting higher. That to feed through into, if not higher interest rates, certainly higher interest rates than we were expecting prior to the war. And it's going to be interesting to think about what that might mean for valuation. So what's your sense of, the overall impact of what this is, what this might do for the sector?
Yeah, so I think a bit like when we were sat here around this, was it around this time last year? We were talking about tariffs.
Yes.
God, what a year.
Yeah.
We were talking about the fact that in the UK tech sector, our coverage, we weren't seeing any first order impacts, and really what we would see potentially is second and third order impacts. If you're an IT service provider, are you dealing with, back then it was a manufacturing company that sold a lot of widgets into the US? What would that do for their spending, project pipelines, etc. We are sat here again saying the same thing. No one that we are covering really is expecting a first order impact as a result of this. But if you are dealing with organizations or your customers are food logistics companies, supply chain organizations, or anything that might be affected by, let's say, a prolonged $100 plus oil sort of environment, and also more broadly reliant on debt and the impact that interest rates might have on investment activity, things like that, then there could be a second or third order impact here, which is, are they going to cancel projects, or are they going to push projects down further to the right? Are they going to reduce spending on tech projects, or are they going to reduce spending or ask for price reductions in day-to-day IT services contracts? Are there particular software implementations that they might now push further along because actually they don't have the CapEx or they don't have the certainty to drive that spend? I think those are all the things that we might expect in an environment like this. The reality, though, is that we've had a lot of questions about this from some of our companies that we speak to and private equity investors as well. I'm not seeing anything, and none of the analysts I speak to are seeing anything immediately. No one's cut their budgets. No one is recut forecasts around this. So we are still in a stage where sort of everyone's sort of sat there going, is it yet? Is it now? Will it come by the end of this year? Potentially, maybe. The answer is, for a lot of people, we don't know. I can see theoretically why someone might see some second order impacts if they are in a bad position with certain types of customers, or they are waiting on projects to be launched and they're just waiting for the sign off on that. The reality is, though, that there's nothing immediately that we can see as an impact. However, I think what this will continue to do is affect sentiment, and it will affect attitudes, risk appetites. We were expecting 2026 to be a year of improved growth rates. I think we were talking about green shoots of recovery as a result of maybe a bit more certainty or a bit less uncertainty. All this does is just creates more uncertainty. So if you were waiting for spending to improve as a result of that, I think that's going to be the issue. I think the impact on interest rates will then affect investment activity and business confidence as well. And then we might get onto it in a little bit as well. Valuations. Does interest rates and a changing interest rate environment have an impact on valuations? I think the answer is yes.
Mathematically, it has to, really.
Yeah. Mm-hmm.
We look at private equity anyway. I think my sense of it is at a high level is just if one of the biggest drags on growth and performance generally, I think, has been longer sales cycles, and that's just been a feature of the market for the last couple of years. And it did feel like that was unlocking a bit at the end of last year and into this year, and it just feels like we've gone right back to where we were. I mean, we're going to talk about growth rates in a bit more detail later on, but that just feels like it's going to have a natural impact. And I think the economy is now forecast to grow below 1% this year. It's hardly worth talking about in terms of growth. So I think as I said, we'll talk about growth rates in a bit more detail in a minute, in a while. But I'm a bit more positive about the impact of the Iran situation than I was a few weeks ago. I was really quite concerned about the impact it would have, but it feels like, and maybe it's just because we've had a bit less bombing, and the oil price has stabilized near 100 rather than it was heading up to 150 at one point. But I think we've got to accept that it might get worse again. But as it stands today, it feels like it's not existential but annoying.
Yeah,
it would be the summary. I'm moving then on to the idea of this SaaS apocalypse. I mean, this has been it's just blown up really in the last few weeks, and it's interesting because I've been talking about this sort of changing of the guard of valuations between SaaS and like the AI haves and the AI have-nots for 2 or 3 years now. Mm-hmm. But not even, and the idea behind that was obviously that, SaaS valuations were kind of table stakes and they would normalize to a lower level. And then those companies with an AI native or certainly a strong AI strategy would be the ones with the premium. I never realized it would happen quite so dramatically though, as it's happened. And I mean, just to take a step back and sort of remind ourselves why this has all come about, some of the changes and the developments, particularly with Anthropic's Claude in the last 6 months or even less than that, have been, striking. Coding particularly, but across the board. I think the thing that really kicked it off was you might remember, I forget the exact functionality that was brought out, but it was the legal sector. Claude was looking to do more in legal sector, I think it was, that really
talked about
freaked everyone out.
Yeah.
Verticalization of some of the LLMs, and that's why I think got everyone sort of concerned, and it's really gathered a lot of momentum. And more recently, we've had Claude Mythos, that's impacted all the cyber stocks, and it's had a massive impact on share prices. I mean, the one that I am always fascinated by is the HG Capital Trust. So this is the listed element of HG Capital's funds. So it's a very interesting barometer of the confidence. It's not a comment on HG Capital per se, other than the fact that it's a big software investor that everyone knows. But it's just interesting in terms of a sentiment measure for private equity, tech sector private equity, and that's share price, which is generally very stable, dropped 30% in a week. And I don't believe it's ever done that.
No.
And it's not really, it recovered a bit and it's up and down a bit, but it's still down, I think, 25% year to date. So that's a really interesting symptom of what's going on here. And then in the US, you've seen a lot of the big private equity funds that are very heavily focused on software, seeing their share prices like the BlackRocks of this world, Blackstone, dropping very rapidly. So we've seen immediate impacts from this on share prices, and, it's fascinating to think about how it might play out. I don't know if you've got any thoughts on the impact before I dive into some of what I think the longer term impacts might be.
Well, I'll leave sort of the main bit to you, because you obviously wrote pretty punchy piece on it, which obviously we got a lot of nice feedback on around the realities of all this. I think I'll let you touch on software. I think if I try to bring this back to ICT, is there an impact first? The answer in this specific case is no. I think fundamentally there are views on the business model in IT services, whether you're a managed service provider, whether you are a telecoms business, whether you're a consultancy, and there are AI impacts to all of this, and we've talked about that in the past. But this particular development and the SaaSpocalypse, I think, is separate from ICT services and any conversations there. For those companies, what they're being tested on is their product and service strategy. Are they utilizing the right tools in their delivery? Are they utilizing the right tools in order to improve their own margins and cost of delivery and things like that? Do they have a product strategy that might involve supporting organizations in deploying AI and things like that? So there's a whole conversation to be had there. Is the SaaSpocalypse affecting the valuations or the investor viewpoint about an ICT services company? Not really. If there was, it might be because this ICT services company is very heavily IP driven, let's say, but we don't really cover those kind of companies. So I don't think there is that huge or a significant element to that. Really, where we have been seeing, and this is where you sort of commented, was the software market and what do people think about software companies, all this talk about systems of record versus systems of action, which are now everyone on LinkedIn seems to have become a software analyst overnight because they're all throwing around these terms. And I think for me, the reality is understanding where the AI assets are for a software company, what is defensible, what is a competitive moat, and being really honest about what your competitive moat is. I think that's probably where the conversation needs to be a bit more grown up rather than just going, software is dead, Claude's going to just take everyone's market share. There's some element of truth to that, but I think it's a lot more nuanced, and I'll let you.
Yeah, I agree with that, and I'll come back and talk about some of our own AI strategy framework and what it means for that as we wrap up this section. But I think so. I don't know. It's maybe quite a controversial view, but it feels to me at the moment like we're at peak AI. And when I don't mean that from an implementation point of view, because we're obviously just getting going on that. Yeah. I mean from a sentiment perspective. And I think it's really important that we take a calm view of what's going on at the moment and look at what's happened in the past. AI is in my 30 years doing this is far and away the most significant trend that I've seen, far more important, significant, both for the sector and societally than SaaS and all the rest of it. However, when I think back to the dot-com boom where I was an analyst working away in the city, there's definitely things going on now that feel quite similar in terms of the way people are viewing AI and AI stocks. I'm not saying there's a big crash coming, by the way, because I don't necessarily think there's some kind of dot-com style crash coming. I'm not saying that. But I use the example, and we were talking about this earlier, of some of the food delivery companies, because back in 1999 it was all, bear with me on this by the way, I'm going to get to a point, but back in 99 and 2000 there was tons of money going into food delivery. It was all about digital, it was all about the early days of the internet, everyone was going crazy, and a lot of people genuinely believed that, when I say food delivery, I don't mean Deliveroo, I mean Ocado-style businesses.
Right.
And a lot of people genuinely believe that what was described as bricks and mortar supermarkets were dead, right? So Tesco's share price collapsed.
Why would you ever go to a supermarket?
Why would you ever, if you could get it delivered, blah, 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 go do it on the internet, blah, blah, blah. So in a very, supermarkets versus software companies, but the same idea really that, the old guard were dead. And there was you have to remember, there was a real sense that was true. And it feels a bit like that with the existing software companies or some of the established software companies at the moment. And then there's the famous one, for the infamous one from the dot-com period, is Webvan. A California-based food delivery, Ocado-style business, which spent a ton of money on CapEx infrastructure, big warehouses, etc., and probably went bust after 2001, 2002. I don't remember exactly when it went bust. And obviously, Tesco's still here, and Walmart is still here. So I'm not saying that the AI companies are going to go bust. The point I'm trying to make is, I think we have to remember that there are a lot of flaws in the AI native business model that people aren't talking about at the moment. I'll get on to talk in a minute about how there are obviously challenges for existing SaaS companies. I'm not suggesting that the threat is not real, because I definitely think it is real. But you've got to look at these AI native companies. A lot of them are fairly thin feature sets sitting on top of LLMs. They're operating at very low gross margins. They're operating really at a services gross margin, 40% in a lot of cases.
Yeah, that's a good services gross margin.
Exactly. Yeah. Their feature moat is limited in many cases. And, I think that the market has swung, in my view, too far the other way, too far that way in terms of thinking about AI and how strong it is and how it's going to kill SaaS. And I think what we will probably see is we'll see some normalization over the next couple of years. I'll come back to that in a minute. If you think about existing SaaS, if you think about SaaS companies, I'm not suggesting for a minute that there is not serious risk for those companies, particularly where they are point solutions where they are not embedded into the cost of changing is relatively low. The cost of switching is relatively low. But if you look at something like an SAP or particularly likes of ServiceNow, relatively new companies compared to SAP. Mm-hmm. I mean, do I think that there is an existential risk to ServiceNow from LLMs? No. It's a typical ServiceNow implementations plugged into dozens, if not hundreds, of other systems. The cost of change is massive, and
or in Salesforce, like people literally this year, people are going to say, "Oh, this is the end of Salesforce," and I'm just sort of sat there just going, forget Salesforce as the UI and the software application itself, just like the data that sits within it, the way that people use it, the integrations it has with other parts of your technology stack. If you think Coca-Cola is moving off Salesforce just because there is an AI startup in there, but that feels like the attitude that seems to be in the market. Sort of, oh yeah, this new AI native CRM, because its feature set is AI based, will just replace a Salesforce overnight, or even in a 2 to 3 year time period. It just feels, I don't know. I'm not a software analyst, but just
I completely agree, and I think that so we're just you look at this on the basis of just the pure LLMs. A lot of people are switching away from ChatGPT into Claude at the moment, whether that's on their desktop or for coding, particularly because there's been massive advances with Claude over the last few weeks and months. Who's to say they won't switch back? The switching cost of moving from Claude, from ChatGPT, I forget is it Codex? Their coding feature versus Claude Code is zero. Like there's a zero switching cost. Yeah, and so. And that's true with some of the applications built on top. There's a very low switching cost. So I think we need to remind ourselves that the AI native stuff is incredibly powerful, but also has its flaws. I think we also have to remember that. But also that they have huge momentum, brand momentum. I'm not talking necessarily just about the LLMs. I'm talking about all the Lagoras and the Harveys and the Sierras and those companies that are gaining huge traction in their markets with AI native products. And they have huge funding as well, which is the other thing they can. I mean, was it Lagora raised $500 million on a $5 billion valuation, and this company's only been around a small number of years. So there is a big fist fight going on. Don't get me wrong; it's going to be a big fist fight. Do I think that the investor sentiment has moved too far one way towards AI? Yes, I do. Do I think it'll normalize? Yes, I do. In the meantime, and I'll come back to what we think people should do about that at the end of this section. But in the meantime, we are seeing complete panic on the part of the investor community. We already know software private equity deals are not happening. I think the private equity community will put their pens down, whether that's investing in MBO type, first capital in type transactions. A lot of secondaries are going to get delayed. No one wants to be the first to put their market down as to what they're going to do. Particularly around there's two things really. One is what is my 5-year business plan? Well, most people don't know what their 5-month business plan is at the moment because so much is changing. So that's a challenge for any private equity investor looking at that time frame. But also valuations. What does this all mean for valuations? And so I think we are going to see a very, very low level of software transactions this year, and we're going to see hold periods go out, which causes a whole nother series of other problems. I think we're going to see and we already have, I'll come on to this later, we talk about M&A activity. We will see a lot less M&A activity from the software companies. Of course, talk about the private markets in a minute, but that's a factor there as well. So just corporate activity is going to be much lower. I think it's inevitable for this year, really.
Which comes back to a topic that we've talked about, I think, for the last 2 podcasts alone, which is this bifurcation, because we're not saying it's going to zero, because some transactions will still happen. But I think the reality is that there will be a very clear bifurcation between the deals that get done and the deals that fall over. And probably one of the key differentials will be AI product service strategy, I assume. Well, they need, it's not even a 5-year view. I'd argue it's a 10-year view, because especially if you're thinking of doing the buy-in.
Who's going to buy it from me in 5 years' time?
What's in my exit paper? Yeah. So I think there's a real point here, and it feels like it's happening across the big ones, but also even the mid-market and even the lower mid-market. If you're trying to do your first deal, your primary buyout, having that view of what this company will look like and what the AI product service strategy is in 10 years' time, it's probably going to be one of the key things to get your deal across the line.
Yeah, agreed. And I think the third point really to make is on valuations. And when the dust does settle, I think we start seeing a reasonable number of transactions where we can get a sense of valuations. I think what you will see is, so what we've seen up until now is we've seen high quality software SaaS assets. I don't like the term assets. Companies. They're companies, have people in them. Trading in 20-ish times, sometimes a bit higher than that, trailing EV/EBITDA multiple. I think those days are gone. We'll talk about the impact of private markets on that, because that's going to be a factor as well. And I think if you are a low growth software company with any perceived AI risk, or just generally in a part of the market that is not perceived to be very exciting, it feels to me like valuations are going to be below 15 times EBITDA. So the higher quality SaaS businesses will drop. I think everyone's going to come down by two or three turns.
Yeah,
at least. Probably more in the short term, and I think valuations will normalize for non-AI businesses in that kind of low teens to high teens rather than mid teens to 20.
Yeah,
that's where my sense of where it's going to go. So that's a quick kind of thing. We'll wrap up, I think, at the end of this section thinking about actually what people can do about it, because it's kind of important. But maybe let's just chat a bit about private debt markets as well, which is our third
horseman
of the 3. There should be 4, but why don't I let you chat about that, because you've been doing a lot of work on this and I've been talking for a while.
Yeah, and I'd like to preface this by going, I'm in no way a private credit analyst, and I'm going to come at this actually from the perspective of not trying to give you the world's best explainer on what's going on in private credit markets, but instead what we think the impact on the UK mid-market tech sector is. Fundamentally, we've been seeing a lot of headlines, and we've been getting a lot of questions as an analyst team around the private credit market, the meltdown, air quotes for those who are listening, in the US private credit market. This companies like Blue Owl, for example, have taken up a lot of headlines recently. There's a lot of investor redemptions in those funds, which are open-ended funds. And does this mean, that significant source of liquidity to the US private market, so private equity in the US have taken a lot of money from these guys. What does that mean for the UK tech sector? Does this mean that, that liquidity pool is sort of evaporating in the UK? The reality is that the UK market and then what you see in the headlines in the US market are quite different. It doesn't mean that there's no impact or we don't foresee any issues, but I think we should highlight the fact that there are quite different dynamics between the US and the UK. Firstly, I suppose the size of the US market and the size of those private credit sort of institutions in the US, very different. I think also the fact that there is a lot more retail involvement in those US markets as well. So Blue Owl, for example, has a significant component of retail in there.
Which I think was a surprise to both of us when we looked at that. I think we had both assumed that the source of capital for those guys was institutional.
Yes, exactly.
Overwhelmingly institutional.
Yeah, and open-ended funds. And I think the UK largely, and certainly the markets that we deal with in the mid-market, the funds that are involved are certainly much more institutional, and they are largely closed-ended funded as well. So I think that whole point about redemptions and does this mean there's a lot of liquidity leaving the market, I think is more of a factor in those US sort of situations than it is in the UK. However, there is a very real factor that some of the sentiment and some of the reasons behind the redemptions, a big part of that is exposure to software. So in the US, there is a significant exposure to SaaS and software within the private credit funds themselves. If you look at what they have then been supporting in terms of direct lending or indirect lending, has gone into software. In some cases, I think some of these funds are 25%, 26% of their funds are in SaaS and software alone. So not just technology, SaaS and software in and of itself. So if you combine that with what you just talked about there, the SaaSpocalypse in 2026, like some of this investor sentiment, if you then got retail investors who see that, get spooked, all try to then
becomes a self-fulfilling prophecy to some
becomes a bit
degree.
of a self-fulfilling prophecy. Now the reality is they're not all pulling their money out, so it's not like Blue Owl's going bust tomorrow. But that has an impact then on sentiment, and I think that sentiment is the piece that we should be conscious of when we look at the UK markets. Even if the UK markets and the firms operating in the UK and in, let's say, broader Europe are a different structure, much more close-ended, much more about institution rather than retail, all of these kinds of trends have an impact on sentiment. And that sentiment can come out in different ways. It can be just different risk profiles and much, much less investor appetite for risk. So when they're looking at a SaaS business or they're looking at any sort of investment and supporting and sponsoring that investment, they're looking at what is the risk profile of this company, and their risk criteria have now changed fundamentally. So will they lend the same amount at the same interest rates? The answer is most likely no. Will they have much more stringent covenants? Probably yes. And so all of these things will affect deal structurings, and all of these things. And when you have impacts on deal structuring, you have impacts on the valuations, the actual multiplier that someone will pay on the equivalent business. I think that will have an impact. So for me, it doesn't suddenly mean that there's going to be a dearth of lenders willing to lend against software multiples purely as a result of this, but I do think that it's going to have an impact on the actual structuring and the funding available. I do also think for some of those companies that sold or did a private equity deal in, let's say, 2019 to 2022 at very high multiples, that was premium market multiples. If they're coming for refinancing, what does that mean? What kind of interest rates will you then get?
Well, some of those companies have got leverage up towards 10 times.
10 times bank debt.
Yeah, bank debt on free cash flow.
Yeah. So you look at that and you go, right, the risk profile on that business now is quite significant. And now you've got a lending environment which is much more complicated. And you've got the Iran war that has an impact on the UK macro sentiment and overall bank interest rates. I think the three horsemen, three-headed dog.
Yeah, whatever it is, they all come together. Right?
They all come together into one, which is why I think our views this quarter have been so much more negative than I think we tried to be in January, because I think we have had three pretty significant market level shifts, which will all have an impact in one go. Sorry, that was a...
No, I mean, I think, and just to sort of expand a little bit on how that the private debt market interacts with the SaaSpocalypse, is... Again, mainly the larger end of the European software market. I don't think these guys have been the big guys, the Ares. They're not particularly active at the lower mid market or even the mid market. I mean, to some degree. So I think it is more of an upper mid market and enterprise, whatever you call the top end. billion plus deal size, and those are the guys that had the highest multiples. And actually, multiples were. So you've already had. If you think about that, if you're a big software company, you did a deal in 2022. You may well have got 25 times EBITDA on that deal. You've already seen a valuation compression of probably 3 to 5 times EBITDA already before any of this was going on. We just said a minute ago, we think we're probably seeing another small handful of multiple turns coming down again. Meanwhile, your leverage has been probably going up because you've been paying down less, maybe doing a bit more M&A. So whereas you might have had 7 or 8 times of leverage at the time of the deal of 25 times. So you had less than a third maybe of your capital structure in debt in terms of the valuation, the enterprise value of the business in debt. That might be 50% or more now. It's pretty uncomfortable. And a lot of these companies are not covering their cash. Even before acquisitions, they're not covering their cash interest, let alone the roll-up PIK debt. So it's pretty uncomfortable. Having said all of that, these are if you strip everything back, software companies remain highly cash generative.
Yes.
If they pull back on M&A, which I'm pretty sure they will for multiple reasons, partly because it doesn't really feed in well into the AI strategy, and also just because they want to start more of the profit dropping through into free cash flow, net free cash flow. I think I don't. There's some people talking about some fairly dramatic numbers about defaults. I think that's probably overblown a bit in the software sector.
At least in our context.
At least in our context. Yeah. I mean, maybe maybe some technical defaults. I think that's likely, but actually, will the debt funds see massive loss ratios? I don't see it. I don't see it, to be honest. The private equity funds, different conversation in terms of their return on equity. That's where I see the risk, less so for the debt side of things. Anyway, so I think I'm apologies to listeners and viewers that this has been a bit of a fire hose of negativity since we started, but things have got a bit challenging. I mean, anything you wanted just to cover on the private capital markets, private debt markets, or I'm going to say a few words and we can say a few words about strategy. But
no, I think we've covered it.
Okay. I mean, I think really, and this is in some senses not rocket science, but I think we're still quite surprised at how many companies we talk to are not sufficiently leaning into our AI strategy. But the net of all of this is, whether you're software or ICT services, is you have to have a really, really coherent, well thought through AI strategy. And that doesn't just mean I'm using Claude. It means understanding your market opportunity, how AI is going to affect your market opportunity, how that translates into your products and service strategy, what are your AI assets, as you said earlier, how are you leveraging those AI assets into a really competitive products and service strategy over the medium to long term. What is your execution plan around that? Where are the gaps? How are you going to fill the gaps? Are you going to fill the gaps organically? Are you going to fill the gaps with M&A? How does that feed into your M&A strategy? What's your people strategy, etc.? So really doing that, and Megabuyte has a framework of was 10 questions, now 8 questions that every board should ask themselves, and that is even more valid today than it was when we launched it a couple of years ago. So I think our message is just that, is leaning in. The only solution here for an established software or ICT services vendor is to double down on your AI strategy, make sure that you are really on top of it, and ensure that you are that it's constantly updated and it is really comprehensive, and that's the only thing you can do, really.
Yeah. One starting point for free, Cameron and I will be talking about this in our upcoming CEO Strategy Offsite presentation. We're doing one on AI product service strategy in that event. One of the free bits from that I'll give on this podcast is who's running that strategy. I think you've talked to a couple of interests. So I think there's a lot of people that are sitting there going, okay, I need an AI strategy. I'm going to shove that on my CTO and they'll build the AI strategy for me because it's a technical question. And I think your view, and echoed by the whole Megabuyte team, is I don't think that's necessarily that's one part of it. In some cases, I think it's actually a CEO level problem. And if I had to describe who I think should be a chief AI officer, if you don't actually have a dedicated role for that, is actually the CEO is doing that. They're building that product service strategy. They're doing the understanding of what does this mean for my addressable market. Now, you can pull on your various different bits of your C-suite to answer bits of that. So you might get your CRO to go and figure out what the addressable market is and what's the intent signals and go-to-market strategy around that. The person that seems to actually, for us, be doing quite a lot of the stitching together to build that into an AI strategy has to be the CEO, because I think it touches on every single part of it's the CEO, it's the operational strategy, it's the technical strategy, it's the sales strategy and the go-to-market strategy. It's what's the cost of that and the ROI. That's your financial strategy. So it's and the people strategy as well. So
yeah, okay, yeah, and I think just to finish off this bit, I think that is one of what we would sort of highlight as 5 key enablers, really, of an AI strategy, even above the 10 questions which I mentioned before, and management vision and having a clarity around whose responsibility AI is, as you just said. The second one is being agile. So I talked about making sure your strategy, I mean, the last few months is proof of that. Things can change and will continue to change very rapidly, and making sure that, that you're on top of that and there's no dogma. I mean, this is slightly what it is, but technical debt, minimizing technical debt. And I think that means really, obviously your technical debt in the business is what it is, not acquiring more technical debt. We've been saying this for a long time. So if you do have, regardless of where your technical debt is now, but especially if you have quite a lot of technical debt, doing acquisitions that are going to add to that, either because they have older technology themselves, or because just the complexity of integration is a bad idea and will cause more problems than it solves. Leverage, we just talked about that. This stuff costs money. It's going to be very difficult for any company to execute an effective AI strategy without spending more money than they're currently thinking. And there's still a lot of happy years about this. I don't know what you think about this, but there seems to be a lot of happy years about this in terms of people think, and a lot of the private equity investors seem to want an AI strategy with no extra P&L hit. And that's just not realistic. Maybe on some of the internal investments, but in terms of your products and service strategy, particularly if you're a software company, you are likely to have to increase your spend as a percentage of revenue. Now, there's all of the operational efficiency with coding and so on, which is massive. But even with that, it feels like the overall spend is going to need to go up. And lastly, before I let you comment on any of this, being fully funded and having aligned investors. So those two, the last two, are very obviously closely aligned, but ensuring that your investor base is aligned with the reality of the world now, and is not expecting miracles, and it's expecting that this stuff costs money is super important as well. So those are kind of the 5 things that are enablers, that most of which are in the hands of the board. What are you seeing in terms of that leverage piece and how that's impacting on strategies?
Without giving away any confidences, I think probably the biggest issue for the management teams that I'm speaking to and the team I'm speaking to is that alignment between investors and the management team. And I understand it, especially if you're 3 to 4 years into an investment cycle, you had planned to exit or start to think about your liquidity options at this point, and suddenly the management team sort of sitting there going, we can't actually exit, or we won't get a good result if we try to exit at this point without a fully thought through strategy. Whether it's a pure AI related strategy or just a general product service strategy, what is the exit paper for 5 years' time to whoever we're selling it to? There is misalignment there because of the investment that is required. So we'll deploy Claude, or we've given everyone a Office 365 Copilot license. We have an AI strategy, and it's that. I just don't think that's going to hold water, really. That's table stakes. It's been table stakes
for a while.
So it's sort of okay. That's just like saying I've got Word,
but also
and I use Excel.
A PowerPoint. 2 years ago, I think we said, and I think was the case, that if you went into a private equity round or even an IPO, which there haven't been any, but if you were going to do that, the ability to say, look, this is our strategy was adequate.
Yeah.
But actually that you need to be doing now, really, to be able to, you need to be proving that the strategy is working.
Yeah.
To really, get the result you want in any kind of investment round or transaction.
Yeah.
If you can't do that, then I just don't think you're going to be able to get anything done at the moment.
And so the first thing you need to do is get that alignment between the investors and the management team between what actually needs to be spent. So if you are MSP, are you looking at your ITSM platform? Are you using the right one? Is it got the right features available in order to be able to deploy the solutions that you need to do? If it's about automation of ticket resolution or whatever, have you got the right solution in place? Have you already used it? Have you gone through the pain of doing that? Having a clear conversation with your investor and going, this is what we need to do, or with your, if you're owner managed, you don't have an investor, whoever the founders are, if you're the founder, you've got to probably deploy some cash and invest in these solutions before you get anywhere near a process. I think this idea of, okay, I'll get into a process and I'll write a nice paper saying that once we get the investment, I will then deploy these solutions. It might work, but God, you are asking a lot of risk to be taken on by that person who's buying into the business.
Yeah.
And so it's a very different valuation and process conversation, I think, if you don't have that.
Okay, so we intentionally spent quite a bit of time on that because it's all really pretty important stuff, and we're going to, as we always do, spend the rest of the time going through some of our growth expectations and then some of the corporate activity trends we're seeing. So we touched on where the impact of the Iran war on growth, but just generally, just update us a bit, Neil, on what you're thinking and what your team is thinking about growth rates.
So unsurprisingly, our quarterly sector barometers have come out today, and they're recording. And the guys on both sides of the aisle we've basically as a research team, we've reduced our growth expectations for this year, not massively, and frankly, I think. This was pre-Iran war, really, as well. I think it's probably connected more to general UK market growth, but then also some of the stuff we've seen coming through the software companies, the ICT companies that we've spoken to. The forecasts and the guidance we've been given suggests that now we're looking at more like a 4.5% growth rate by the end of this year.
And that before that was more like 5%.
So it's dropped by 0.4 to 0.5 percentage points, and then software excluding VC has dropped by a slightly lesser amount, 0.2 to 0.3 percentage points, to more like 7.5% to 8%. So it's a really difficult environment because we sort of sit there and go, there's all this big stuff happening, which suggests, and we've talked about it on this podcast as well, that that could have significant impacts. The thing is, we're not seeing those financial impacts yet. And as I've said, management teams aren't sitting there making massive downgrades to budgets as a result. What I should highlight, though, is this is still an acceleration in 2025. So as we see it now, 2026 is expected to be a better growth year than 2025 was. It feels like 2025 was the nadir, but that could all change over the next, what could $100 oil do to the growth rates? How big are the projects, pipeline delays, etc., could have significant impacts. Some parts of the market might be more impacted. So, for example, we look at our IT consulting coverage. A lot of project-based businesses in there that are reliant on discretionary spend, and if that disappears as a result of a tougher macroeconomic environment, that market could be much more impacted. Other areas which have higher recurring revenues and 3 to 5 year contracted service lines, those could be a bit more resilient, at least for this year. So I think we're keeping our eye on it, but at least for now, we've sort of still reduced our growth outlooks for this year.
And I think our working thesis on software is that despite all of the disruption on the SaaS apocalypse in terms of corporate activity and valuations, we're not expecting, I don't think, that to have a material impact on demand. Software demand, as in end customer demand. I don't think we are expecting end customers to go, well, I'm not going to buy my new CRM because I'm concerned that AI might make it redundant. And we're not seeing that at the moment, are we?
No, but I think it just keeps coming back to that idea of sentiment. Yeah. It's so difficult to obviously turn that into some sort of number that everyone can use in their board pack. But the reality is sentiment is souring. People are a lot more choosy customers. The sales cycles are still difficult and long. People will want bake-offs of different solutions that maybe previously they would have just waved through. I don't think any of those things are new. That's what we were seeing through 2025. What's happened is that we were expecting that to all ease and things to have improved and sentiment and certainty to improve. And it feels like that's just not going to happen now. And we're still going to be in those same tough trenches we were in last year and the year before.
So to pull those strands together, it feels like, so we've downgraded a little bit. We still think growth rates are going to be marginally better, a bit better than they were in 2025, but the risk, as they say, is on the downside from here. So it could be that we'll see further weakness to our estimates as we go through the year. Yeah. Okay, looking at the various different asset classes we talk about, thinking about corporate activity, starting with capital markets. Just run through the stats. Again, super quiet. I mean, like hilariously quiet. Just 3 deals on our database in the first quarter of the year. That was down from 7 last year. And no IPOs again. The IPO market is broken for the moment.
One of the big holdouts we were waiting for was Visma, wasn't it? And obviously now that's been officially delayed.
Yeah. £2.9 million raised from 3 follow-on public offerings in the first quarter, which is also hilarious.
What are the broker fees on that?
Not enough. But I think probably what we wanted to focus on, which I think are the more significant news coming out, is really more public to privates. The most significant one being Gamma, which has had formal approaches, I think.
Yes.
We don't know who, do we? And the other one was Aptitude. And I looked this up, that those of you who have got long memories, even longer than mine actually, this was Microgen before, and it listed in the 80s.
Yeah.
So this is a talk about a long-standing part of the market or company on the market. So those two companies, billion market cap between them. Obviously, Gamma's most of that. Aptitude's about 100, I think.
Yeah.
And Gamma's sort of 800-900 now, isn't it? Anything else you wanted to add on Gamma? I mean,
I think obviously from a telecom services perspective, and my enlightened colleagues Philip and Tom will talk about this and have talked about this in much more detail in their notes on it. But obviously, I think as much as Gamma is a significant player in the telecom services space, I think this is as much symbolic as it is sort of significant financial sign. It's been listed for a very long time. It's been seen as the real telecom success story from a UK listed perspective. Went from AIM to main market and things like that. So really for the listed telecom space, this has a big impact on what people look at. And you look at Gamma's valuation and you go, in a private market, it has a significantly different valuation profile than it does on the public market. So again, it just continues to reaffirm this view that there seems to be a very different pricing and valuation attitude. And for management teams and for companies that are sort of sat there going, why is our valuation not what it should be? A private takeover looks very attractive because they just think of that as a very different sort of story, very different valuation on their effort and their sort of trajectory. Gamma's had a fantastic trajectory, and so I think it's disappointing more than anything else. So the fact that they'd even consider
disappointing, but also no one was surprised when that announcement came out. I mean, literally nobody. It was like, oh, Gamma's being taken private. Oh, okay, yeah. Well, we all saw that coming a million miles away.
Yeah,
just because of the quality of the business and the disconnect with the valuation.
Yeah. And it might still not happen. Obviously, we're still very early stages. They're still sort of there in that.
We know if it doesn't happen now, it'll happen at some point. I mean, that. I mean, you can never say never, but that feels. And for those of you who are subscribers to Megabuyte Research, our colleague Philip Cast has done a lot of detailed analysis on who might be the buyer, and there's lots of different options there in terms of who might do it, PE backed, etc. There's kind of interesting.
Could be trade as well. Could be an acquisition. So
and more. I think we think more likely to be a PE backed trade than necessarily a PE outright purchase. Yeah. But that's also an option. So disappointing as much as anything else. And I think the de-equitisation continues. Interestingly, though, I mean it's probably too early to even go there on this. But from a software perspective, when you think about the compression of valuations we just talked about before, private equity valuations, software private equity valuations coming down, if we see a convergence of private equity, which have for a long time now been in a significant premium to the listed software multiples, I think the average multiples are a bit of a misnomer. I mean, an okay, well-run, decent software company on the London market is trading low mid-teens EV/EBITDA multiple for the most part. If those converge, I do think it is possible that we will start to see more software company IPOs in London. I'm not saying that's going to happen anytime soon, but if there is a prolonged issue with private equity demand, or for secondaries as much as anything else. I mean, the MBOs, if you're a profitable business and you're owner manager, you can just not do a deal. But you can't not do a deal as a private equity firm with an asset in your portfolio forever. You have to return the money to the LPs at some point. And so that could be a feature, but I wouldn't want to overstate that. But it feels like if you get that normalization or that convergence of valuations, that could happen.
The joke in the office.
I mean, I'm being very hopeful because I think we all want to see a stronger tech market on the London market. But
although that point there about what can private equity do, eventually there is a ticking clock. The joke in the office is around continuation funds. Oh, just sell it to a different fund.
That becomes a lot harder as well. And moving on to private equity then, I mean, I think that ironically it was a very strong quarter for private equity deals. 26 private equity deals compared to 18 in Q1 last year. Even split between software and ICT services. Really good spread of deals across 10 MBOs, 12 secondary buyouts, no public to privates, and some carve-outs in there. So it was actually a really strong period. I mean, I don't think anything particularly we can hang our hat on in terms of deal trends. I mean, some positive, some less positive. A couple of the larger ICT services companies still, or telecoms and ICT services struggling and doing deals because they're struggling rather than from a positive perspective. Carve out of NCC's S-code business. So there's quite a lot going on. I don't think anything we can particularly hang our hat on from a valuation perspective.
No, not really. And I think some of the positive deals that did happen in ICT at least were really high quality businesses that actually interestingly got sold for very premium multiples. So again, it reiterated what we said in January about this bifurcation in deals of if you're a high quality business, a high quality model, right strategy, right product service strategy, there are still deals to be done. There's dry powder that wants to deploy, and you can get a pretty punchy premium multiple. Obviously, that was all. I think a lot of that was pre-SaaS Apocalypse. Difficult to say whether that would still happen now.
It's interesting whether
so.
The SaaS Apocalypse will have an impact on some of that infrastructure stuff. It doesn't seem to be at the moment.
No, not at the moment. There's still a lot of interest around IoT. There's still a lot of interest around some of the more infrastructure type assets. There's still a lot of interest around data center, the neo clouds and those kinds of businesses. There's a lot of infrastructure money going into those kinds of areas. So I think, but that's sort of outside of the core remit that we're talking about here. There's a much more infrastructure type conversations.
Yeah, I mean, I think from a software, I think I've talked about what we think about from a software valuation perspective, and the trajectory is down. And interestingly, that will therefore, and I think what we're saying is ICT services is relatively stable.
Yeah,
there's no particular, and actually. Overall, the average is probably rising slightly because you've got those infrastructure elements which are rising again. And so we are therefore going to see a convergence, I think, some convergence, I don't think full convergence, but some convergence between software and ICT services where that premium has been pretty stable for the last quite a few years.
Yeah.
Interestingly, the last time we saw that convergence was when everyone was crazy about hosting companies back in the teens, in the 2010, 2015 sort of time frame. Before the hyperscalers came along.
Well, yeah. Well, this was interesting when we had the sort of prep session around this. We were talking about this very topic, and we were just. You said, "Oh, the software multiples look like they're going to come down." So I said, "So does that mean that's going to push down the multiples for ICT?" But actually,
they're separate.
The point that they're separate. We've always sort of looked at it as the software business model is, air quotes again, more attractive, and as a result, it's got this premium. But if that premium reduces actually because people aren't so convinced that there is a premium there, then it's actually that convergence point, which we haven't seen.
So I think we'll see that, which I think is kind of interesting. So look, in terms of the outlook for private equity, we talked about valuations. I think we've probably also talked enough about deal flow. I think ICT services I don't see any reason why we shouldn't see any continued decent flow of activity in ICT services. I think the mute will be in software. That's where we're going to see a much lower level of activity.
ICT's been in a tough position for a while now, and so I can't see it getting any worse. Where it will stay is maybe where it currently is, or maybe improve slightly, just because maybe there's a bit more attention on ICT. But as you say, software is the one that has further to fall.
Yeah, definitely. And interestingly, talking about venture and growth capital, I think that actually we're seeing finally more than the green shoots there, I think. And I do think there's a corollary here between what's happening in private equity and capital markets against what's happening in venture from an AI perspective. For a while, I've been thinking, where's the AI money in UK tech coming into VC? And we have seen bits and bobs, but we're seeing that come much more broadly now, I think. So there's a total of 4.1 billion raised in venture in the first quarter. Bear in mind that I think the number, I've got it written down, but I think the number for the whole of last year was 6. So, and now there was a couple of very big deals. Nscale, 1.5 billion, Wave, autonomous driving, 890 million. So, over nearly 2.5 billion between those two deals. But even so, very strong quarter. We talked quite a bit about pre-Series A deals being really weak, and that being a worry for the long term. Actually, pre-Series A was much stronger in Q1, which I think is significant. And then Series A and the other series were also solid. So we're seeing lower growth capital deals, but I think that's a lot to do with the unwinding of a lot of that growth capital was going to fiber, and obviously that isn't now for the most part. That's gone into an M&A kind of consolidation mode. So really strong quarter, and a lot of very clear AI investment going in, which I think is interesting. Nscale's one, obviously infrastructure, slightly different maybe. 11 Labs, Wave, I talked about Oxa, the autonomous driving, legal. Lawhive, Sumize, Legora is not UK, so that's not in our stats. But the one I mentioned earlier, massive fundraise for Legora, Enterprise Automation, Granola, Origin in the HCM space, raising meaningful amounts of money. So I think, and then also we've got more traditional fintech stuff still going on in reasonable form, 9fin, Alicia Bank, etc., raising money. So I think really positive in VC, and I think we're going to. I'm not saying we're going to see 4 billion raised every quarter, because, as I said, there was a few bluebird deals in there, but I do think we're going to see a gradual, a strong, much stronger year this year for VC around a lot of the AI investment.
I think the interesting thing I can add is that we had the first data point around VC getting involved with IT services
Interesting.
Just last week. It's one we're not quite announcing yet, just because it's sort of still in early stages. But there is now a VC company invested in an IT managed service provider with the idea of basically doing a service as a software or service as IP type proposition, ripping out core systems and putting in sort of much more AI-driven service lines and operating platforms and things like that. Will be interesting to see how that plays out. That is a very punchy play in a market that you could argue is sometimes slow to move, sometimes quick to move, difficult to tell when or where. So we'll see how that plays out.
I think we are. I mean, it's your area, but I do think we are going to. Again, I think that service as a software thing obviously is a massive thing for the software companies,
yes,
but also for the ICT services companies. And I have a sense that might happen slowly and then quickly. There's no real sign of it at the moment, but when it happens, it's going to happen fast.
Yes,
I think.
Yeah. If this one works, whatever that looks like, if someone can prove that was the right play, I think then we'll see that move very, very quickly.
And so then to wrap up on the on the M&A, to think about that, just lastly, weak. For deal numbers, 131 deals in the quarter, down 23%. All of that weakness is in software. Hard to say that that's down to anything we were talking about early on in the show, because it's all happening now, and a lot of the deals that have closed in the first quarter of this year would have not been affected by that. But software deals were down 30%, M&A deals were down 38%. Maybe that's more of the private credit stuff, because a lot of the M&A is PE-backed consolidators still.
And the large ones.
The large ones, who, as we said earlier, were going to be most impacted by the private credit market. So it's less Iran and SaaSpocalypse and more. They're just like trying to, just focus more on cash flow. So that's very interesting. Again, stuck record now, but that's going to continue, I think. So again, not a huge amount to say on M&A, other than there have been some larger deals. Total Mobile was interesting in software being acquired. That's a long-standing private equity-backed business. Leonardo Decrypt, sort of interesting in the kind of cyber defense, isn't it, Leonardo?
Both, yeah.
Yeah, both. Anything to say particularly specifically on ICT services?
No, there's been a sort of consolidation wave in the altnet sector. I think that's just more of that, which we've been talking about for a while now. I suppose the big one, Accenture buying Faculty.
Yeah, that was a big
if you want to talk about AI and how that plays into an ICT services context, Faculty being the really sexy AI consultancy in the UK, basically eating Accenture's lunch for a while now. So that was not necessarily a surprise. If I think about the companies in the world that could want to and afford to buy Faculty, it would have been Accenture, would have probably been top of the list anyway. So,
and you could almost go as far as say it was designed specifically for that purpose.
Yeah, almost exactly. And I think also I'd probably describe that as just a very expensive acqui-hire. It's just a really, really interesting staff base of proper PhD data scientists, all doing really complex work in complex projects that are millions of pounds in contract value. Just that would have been there aren't many of those in the UK. People have asked us who is the next Faculty. Bloody hell, I'd love to know. But
you can bet your bottom dollar there'll be copycats coming through now. 100%.
Yeah. But I think is that a big trend? No, because I just don't think there are enough companies that are of that kind of quality and scale and profile. Nevertheless, it does highlight, at I think a very significant double-digit sales multiple, the kind of premium that got them, and so people will want to sort of see. People want to pick apart that sort of deal and figure out what made it tick and how you could replicate that. But other than that, not really, not a huge amount to talk about.
And I think in terms just to wrap up then on the outlook for M&A, very similar to private equity. I think we're going to see, as we've said, lower software M&A multiples, particularly because those larger consolidators are going to be doing a lot less. And ICT is probably fairly set, reasonably fair. I think. I mean, all relative to where we are in the market. It's not going to be any kind of boom anytime soon, but no reasons why it shouldn't be reasonably solid.
Yeah.
Okay, thank you, Neil, and thank you all very much for listening. If you found value in this episode, you can explore more expert insights, sector analysis, and the proprietary intelligence that sets us apart at Megabuyte.com. Follow us on your preferred podcast platform, and join us next time for another conversation shaping the future of UK tech.
Great, thanks very much.
Thanks.